I don't know if I'm not seeing the screen anymore. Is it being projected?
Yes.
Rodrigo? It's here.
Yeah.
Okay, so good morning, everybody. But just a moment, you're actually seeing the screen from ABDF. I'm not seeing it. I'm sorry. It's just
we're seeing you, Bruna.
Yeah.
I see it, Jim.
okay. I'll do the book propaganda with my book because I'm not seeing the slide here.
Yes.
So good morning, everybody. It's really nice to be here with you in our second Monday session. This class today is going to be really special because it's open to the public, but also because we have two amazing ladies that know a lot about transfer pricing, international taxation. I know they're going to give a master class about delineation, benchmark analysis regarding tangible goods. And our idea here, as we mentioned in the first, is that you leave out with more doubts because of the subjectiveness of the team, of the transfer pricing itself. But the idea is that you get to learn more about how you actually do the transfer pricing analysis in practice. So what normally Lucia and Agata analyze when they're doing the delineation, when they're doing the recognition of the transactions, and when they're doing the benchmark analysis. But before we start, we wanted to do a little propaganda about our transfer pricing book. It's the second volume of this amazing initiative that ABDF had with the OECD and also with the federal revenue. We launched the first book, I think it was 2023, right? And the first book was at the time we were starting to incorporate a new legislation, the arm's length principle. Afterwards, we had all the experience from this 3 years, almost 3 years now, from the implementation of the arm's length principle and all the challenges and that we do have in practice. In this book right now that we do have here, we are going to have a launch in September. I think it's going to be the 29th. In São Paulo at FEComércio. But the book is already for sale in the editor's website, is NSM Editora. You're going to find a lot of articles from many practitioners, academics, and all the people that are already applying the arm's length principle in Brazil, but also all around the world. So I hope you enjoy it. I think it's a really good book. We do have excellent articles here, and they deal with all these challenges that we do have, considering these 3 years that we already are applying the legislations, the new rules in Brazil, but also analyzing it versus the experience that we do have in other jurisdictions as well. So we also have several contributors that are from other jurisdictions, and they bring in all of knowledge about case law and experience in applying the arm's length principle and all of the challenges that we are going to face here in the future years. Hopefully not as much as them, because we are already getting on board after 50 years. So hopefully we won't have as many doubts as they did have as well, but probably we are going to have some topics in common, or most of them. So that's it. Hopefully you will like the book as well. You, of course, can use it for our class and sessions as well. So going already to our session of today, I'm going to introduce you to Agata and Lucia. Agata is a partner with the transfer pricing team of KPMG. I don't know how to pronounce it, Agata. I'm so sorry. Meijburg.
Yeah, good.
in Amsterdam, and she's a member of KPMG's Global Transfer Pricing Services. Agata has more than 25 years of full-time experience in transfer pricing and advises multinational companies on a wide range of issues, including due diligence, acquisitions, reorganizations, and so many other topics involving transfer pricing. But also she has a lot of experience with APAs. So we would also like to invite you to, if you do have some questions, even if they are just not only connected to tangible goods, but you also have questions at the end, you can do discussions for Lucia and for Agata as well, because probably they do have experience to share with you as well. If you want to also open your camera and join the debate, you are more than welcome to do it. Lucia is the founder of Lucia Advisory. She has just opened her boutique advisory firm. She's an independent Dutch transfer pricing advisory, and she has more than 20 years of experience advising multinational enterprises. Lucia has worked in Big Four, in Lois and Love, if I'm not wrong. She has worked with not just in the Big Four, but also in law firms, and she has also a lot of experience regarding transfer pricing, as well as Agata. So both of them, as you see, have more than 20 years already applying transfer pricing, and we are just 3 years ahead in Brazil. So probably they're going to have a lot to share with us. Anna and Luis Felipe, I don't know if you want to make any comments, and have everybody, I hope you have a really great session. We're going to be here as well.
Yeah,
I just want to thank Lucia and Agata again for accepting our invitation. It's a great opportunity for us to learn with you. Thank you so much.
Pleasure. Happy to be here. Great. We can see the slides now. Thank you, Bruna. So I would like to kick off with part one of today's session, practical delineation of controlled transactions. So I deliberately call this practical because I don't want this session to be a lecture where I simply take you through the definitions of the OECD transfer pricing guidelines. Those you can read yourself. What I would like to do instead is show you how I would actually approach a transfer pricing case as a practitioner. So imagine that tomorrow morning a client sends you an email which says, we have a Brazilian subsidiary buying products from our European company. Can you tell us whether our transfer pricing is arm's length? So what do you actually do? Where do you start? What information do you ask for? Which facts matter? And which facts don't matter much? When do you perform the functional analysis? And when do you think about the tested party? And importantly, at what point do you select the transfer pricing methods? What I hope you'll see today is that these questions are all connected. And if there is one theme I would like you to remember throughout this session, it is this. Don't start with the method, but start with the transaction. Because until we understand what the parties are actually doing, we don't yet know what we're trying to price. So let me start with this question. When people think about transfer pricing, they often start here. Which method should I use? Should I use the CUP, the resale price, the cost plus, the TNMM, the profit splits? And in practice, I quite often see a transfer pricing analysis that effectively starts with the answer. Someone may say, this is a distributor, so let's benchmark its EBIT margin. Or this is a manufacturer, so let's apply a net cost plus. But we're jumping several analytical steps, because before I can decide which method to use, I first need to know what transaction am I actually pricing. Who does what? Who owns or uses which assets? Who makes which decisions? Who assumes which risks? What does the contract say? And does the contract actually correspond with what happens in practice? And only after I understand those things can I sensibly ask which method gives me the most reliable arm's length results. So throughout today's case, I'm deliberately going to postpone method selection. You may already have a method in your mind quite early, and that is perfectly fine. Practitioners form hypotheses, but the important thing that we don't allow is our initial hypothesis to determine the facts that we're subsequently looking for. So a question to class, and please feel free to give an answer if you have anything in mind. So if I tell you only that we have a Brazilian distributor purchasing products from a related European company, how many of you would initially think about TNMM? Any hands that are being risen? And I think if we look in practice, many people will have that as their first reaction. But what I want to show you today is that at this moment in this presentation, we don't have yet enough information to conclude whether the TNMM is the method that we should use. So let's look at this slide of today's case. We have a Dutch company, Anelco, and Anelco develops and owns the relevant brands and intellectual property. It is involved in manufacturing, but also procures products, and it determines the global product strategy. Anelco sells those products to its related Brazilian subsidiary, Brasilco. Brasilco imports the products into Brazil and sells them to third-party customers in the Brazilian markets. We also have an intercompany distribution agreement, and that agreement describes Brasilco as limited risk distributor. Finally, I give you a number. Brasilco earns an operating margin of 3%. So my question is very simple. Is 3% arm's length? So you may think, yes, that sounds like a logical number. But the question is, why would you think that? Because we say it's routine, but have we actually checked whether it's routine? So at this moment, we cannot answer this question. At this moment, I have no idea whether 3% is actually arm's length. Could be too high, could be too low, could be exactly right. We simply don't have enough information at this moment. And this is an important discipline in transfer pricing. Don't confuse a number that looks familiar with an arm's length result. Before we can analyze the 3%, we have to understand the transaction. So let's go to the next slides. So assume this is your client. You have been given the information on the previous slides, and you have been asked to prepare the transfer pricing analysis. What do you ask for? What is the type of information that you would ask the client when carrying out this analysis? So I would normally divide the investigation into several categories. First, I want to understand the business. What products are we talking about? How does the group make money? What is happening in Brazil? Who are the competitors? What drives profitability? Secondly, I want to understand the people. An organizational chart is useful, but I want to know more than just the reporting lines. So who actually makes the important decisions? Thirdly, I want the contracts. Obviously, the intercompany agreements, but potentially also wants to see customer contracts or supplier agreements and other arrangements that help me understand the business activities. Then I want to see numbers and not just the statutory accounts. I may need to see segmented P&Ls, product margins, inventory information, marketing expenditures, and pricing data. And fifth, I want evidence of the actual conduct of the parties. So for example, budgets, management presentations, pricing policies, approval matrices, or other evidence showing how decisions are actually made in practice. This is why I say that transfer pricing report should be the end of the investigation and not the beginning. If you start writing the report before you understand the business, there's a real danger that you simply document the label that you were originally given. So my next step would be to zoom out. Before I focus narrowly on the invoice that Anelco sends to Brasilco, I want to understand the broader value chain. So here you see the full value chain of the business. I want to understand, where does the product come from? Who develops it? Who procures the raw materials? Who manufactures? Who organizes logistics? imports, who markets, who is involved in the selling activities, and who performs customer support. And importantly, where are the economically significant decisions being made? So this broader perspective is important because an entity cannot be understood in isolation. It needs to be seen in relation to the other entity that is transacting with, and more broadly, the group. For example, suppose that Brasilco performs marketing activities. That fact alone doesn't tell me very much. I need to know whether Brasilco is simply implementing a global campaign that's been designed by an ELCO, or whether Brasilco independently decides what the Brazilian brand strategy should be, determines the budget, chooses the channels, and bears the financial consequences. So those are all very different contributions. So when I look at a value chain, I'm not simply asking, where does each activity happen? I'm asking, who contributes what to the creation of value? And how does that relate to the control transaction that I need to price? So this is also why a functions, assets, and risk analysis should not become an isolated table in the back of a local file. It needs to connect to how business actually creates value. Now let's go to the contract. We zoom back into our transaction and we read the intercompany agreements. The agreement tells us that Brasilco is a non-exclusive distributor. It must comply with ANELCO's global marketing guidelines. It has to maintain appropriate inventory and use commercially reasonable efforts to promote the products. And importantly, the agreement expressly calls Brasilco a limited risk distributor performing routine distribution activities. So, have we now accurately delineated the transaction? Well, no, not yet. We have learned something very important, namely what the parties say they have agreed to. The written contract is an important starting point. I'm not suggesting that we disregard it, but the OECD framework requires us to look beyond the contractual label and understand the actual commercial and financial relationships between the parties. If we talk about AI can read the contract very efficiently, but it will not know that reality is different unless we give it the right evidence. So now I want to test whether the written arrangement is consistent with the way the business actually operates. And this is the central concept in Chapter 1 of the OECD guidelines. So accurate delineation requires us to look at the economically relevant characteristics of the transaction and at the actual conduct of the parties, not namely the terminology used in the agreement. Now we speak to management. And if you would like also from a Brazilian perspective to share anything that may deviate, or if there's any explicit confirmation in your guidance towards the OECD guidelines, please feel free, Anna, Luis Felipe, and Bruna. So now we speak to management, and this is where the picture starts to become more interesting. The contract describes Brasilco as a limited risk distributor. But management tells us that Brasilco does something more than we might have expected from the label. So Brasilco has experienced local management, it negotiates with important Brazilian customers, it makes certain local marketing decisions, it monitors inventory levels and is involved in day-to-day inventory management. Its people clearly have significant knowledge of the Brazilian market. So should I now conclude the contract is wrong? Brasilco is actually a full-fledged distributor? No. But at the same time, I cannot simply ignore what I've just heard and continue to call Brasilco an LRD. So what do these interview findings actually tell us? Well, they tell us that we need to investigate further. The important question is not simply whether Brasilco is involved, it is what is the economic significance of that involvement by Brasilco. And an important nuance to make is that a local distributor can perform meaningful commercial activities and exercise real judgment without necessarily making a unique and valuable contribution or controlling the group's most economically significant strategic risks. For example, negotiating with a customer may be important, but is Brasilco free to determine the overall pricing strategy? Or does it negotiate within the parameters established by Anelco? Brasilco may manage inventory day to day, but who determines the significant inventory parameters and makes decisions about material excess or obsolete stock? Brasilco may execute local marketing, but who determines the broader brand and marketing strategy? Those are questions we now need to answer. So more involvement does not automatically mean a different characterization. We need to understand what that involvement consists of economically. Now let's do a little exercise, because one of the important skills in transfer pricing is knowing which facts actually matter. So we have a list of facts about Brasilco here. So Brasilco was incorporated in 1998. It has 85 employees. It leases its office. It determines customer prices. Discounts above 15% require Anelco approval. It has 6 marketing specialists. The managing director has 20 years of industry experience. Brasilco carries 4 months of inventory. Anelco reimburses Brasilco for obsolete inventory. Sales increased by 40% last year. Brasilco developed a Brazil-specific product adaptation, and Brasilco leases its company cars. So which facts could potentially change our transfer pricing conclusion? Well, notice that I'm not asking which facts are interesting. I'm asking which are economically relevant to the controlled transaction. So the fact that Brasilco leases its company cars is probably not going to determine our transfer pricing conclusion. The fact that Brasilco determines customer prices potentially could. On the other hand, the 15% approval threshold is interesting because it qualifies that autonomy. And in practice, an LRD can have pricing discretion. The question is whether it exercises day-to-day commercial discretion or controls the strategic pricing decisions and associated market risk. The 4 months inventory initially sounds relevant, but look at the next fact. Anelco reimburses Brasilco for obsolete inventory. That may completely change our assessment of who actually assumes the economic consequences of inventory obsolescence. And the Brazil-specific product adaptation could potentially be significant. I would want to know what exactly Brasilco developed, who made the decisions, who funded it, whether it is valuable, and whether it is used elsewhere. So more facts do not necessarily mean a better functional analysis. A good functional analysis identifies the facts that are economically significant. Now looking at the FAR, the functions, assets, and risks analysis. You will know this acronym, FAR, but I think the more important question is, why are we doing this? And we're not doing a FAR analysis because the OECD guidelines tell us that every local file needs a table with these 3 columns. We do it because we need to understand what each party contributes to the transaction and what that contribution should earn. Functions tell us what the parties actually do. Assets tell us what resources they use to perform those activities. And that includes not only tangible assets, but potentially also intangible assets. And a risk analysis helps us understand the uncertainty associated with the business and which party controls and assumes the economically significant risks. Ultimately, all of this should help us answering what are we actually remunerating. And this is why a FAR affects almost every later step. It affects the delineation, the characterization. It affects whether there's an appropriate tested party. It affects comparability. And ultimately, it affects method selection. So FAR isn't a descriptive appendix. It is part of the analytical engine of the transfer pricing analysis. Another mistake I've seen in practice is that a functional analysis treats every activity as though it were equally important. So that is not the case. There's a qualitative element to it. Let's say Brasilco processes orders, warehouses products, negotiates with customers, determines pricing, selects customers, and develops a local marketing strategy. Those are 6 functions, but I don't learn much by counting them. Transfer pricing isn't Brasilco performs 6 functions and NLCO performs 8 functions. Therefore, NLCO deserves more profit. I need to understand their economic significance. Order processing may be highly routine. Determining the pricing strategy for an important market may be much more significant. Developing a local market strategy could be important depending on what actually entails. So when I interview business, I spend much more time on questions like, how important is the function to the success of the business? Does it materially affect revenue, costs, or profitability? Does it require significant expertise or judgment? Is it routine, or could it create or preserve something of significant economic value? Those questions help me distinguish between functions that are merely part of the operational process and functions that are economically significant to the transaction. And that qualitative assessment matters much more than the number of functions we contribute or we attribute to an entity. And let's take one specific risk and look at how we would analyze this in practice. So someone tells me Brasilco bears inventory risk. My immediate response is then, what do you mean by that? Brasilco physically has the inventory in its warehouse. We also know that it normally holds around 4 months of inventory. But neither physical possession of the inventory nor the amount of inventory held tells me by itself which entity controls and assumes the economically significant inventory risk. So I need to understand why Brasilco holds 4 months of inventory. And importantly, who makes the decisions that determine the level of inventory risk? So I would start by asking, why is 4 months considered the appropriate inventory level? Who determined that level? Is this a decision by Brasilco that it made independently based on its own assessment of expected Brazilian demand? Or does ANELCO determine, approve, or materially constrain the inventory levels that Brasilco is required to maintain? I would then look at the forecasting process. Next slide, Bruna. Who prepares this? Yes, this one. No, the one back. Yes. Who prepares the sales forecasts? Who reviews and approves them? Who ultimately determines how much product is supplied to Brazil? Brasilco may provide important local market information and prepare the initial forecast. That doesn't necessarily mean that Brasilco controls the inventory risk. I will want to know who makes the economically significant decision on the basis of what information? I would also look at what happens over the life cycle of the products. So who decides which products are introduced in the Brazilian market? Who decides when production should be reduced or a product should be discontinued? Those decisions can be very important to inventory risk. So if Enelco decides to discontinue a product while Brasilco is holding 4 months of inventory, that decision may create a significant increase in the risk of obsolescence. And then I would ask, who decides what to do when inventory becomes slow moving? Can Brasilco independently decide to reduce prices significantly to reduce the inventory levels? Can it return products to Enelco? Can products be transferred to another market? Who decides whether and when inventory is ultimately considered obsolete? These questions all help me identify who makes the economically significant decisions that create, maintain, and mitigate the inventory risk. Now remember that go ahead, Agata.
Can I give it another twist? Because I'm thinking of an example that I had not too long ago, okay?
Yeah.
And I think something that it's very simple in this example is that there is only the Netherlands and Brazil involved, right? Based on your picture, your function analysis. Yeah. But there are very few companies that have such a simple linear supply chain, right? Usually there are other parties of the group involved in the supply chain, right? And that they may affect directly or indirectly Brazil, right? So I just wanted to give an example that I have, and that it basically changed quite a bit the initial analysis that we had done, right? Mm-hmm. Because this was a US multinational that had a manufacturing site in the Netherlands, and the manufacturing site did very much what you say, product development. They were responsible for the marketing. They were responsible for the global marketing strategy. And the Brazilian distributor was very similar to what you are explaining as well, right? But there were two things that were important to us. One was the history, right? Because in this case, your example, the entity was set up in 1998. That's a long time ago, right? And in my case, then the Dutch manufacturers was set up in the 80s as well, a very long time ago. But it was part of a US multinational. So the multinational, even though the Dutch plant had a lot of autonomy, they had certain global accounts that they managed. They had done all the historic R&D investment. The Netherlands did some of the product development, but let's say blue sky R&D was done in the US, right? So I think it's important to think of the global context, just not only the two transactions you're analyzing. Maybe that's something that we didn't mention, that if we focus too much on the buyer and the seller, we are forgetting about the big picture, right? And I think the history of the company sometimes is very important as well, right? How the company has grown in different markets, because maybe Brazil was the first subsidiary in Latin America, right? And it opened up the market for other countries. In my case, the twist plot was that a Brazilian parent company bought the US group, okay? So I had a TP policy that worked when my ultimate parent was a US entity, but when Brazil buys my manufacturing and the distributor and a few other plants, the whole economics of the group changed, right? And you could see, well, it's the same. The Netherlands manufacturer, there is a distributor in Brazil, some other things happen in Brazil, but the whole group changes, and therefore the strategy of the group and the way they approach the market changes completely, which forces you to change the TP policy, right? Just to say, well, this is very dynamic. It may work 1 year, but mid-year it doesn't work because of what I just explained, for example, right?
Yeah. No, so for sure it's dynamic in time and in doing the analysis. Things can
Thank you.
change. And when you're doing the analysis, it is dynamic to reiterate. Thanks, Agata. So if we go back to the risks we just started with, and we're looking, so slide 14, Bruna, and we take the agreement as our starting point and ask whether the actual conduct supports that risk allocation. Suppose we find that the Dutch entity determines the overall inventory policy and target stock levels, that it controls the production and supply decisions, makes the important decisions about product introductions and discontinuations, and determines or approves the response to material excess or obsolete inventory. Brazil, on the other hand, physically holds the inventory, monitors the local stock levels, prepares the forecast, and carries out routine replenishment within the parameters established by ANELCO. In those circumstances, the actual conduct would support the contractual allocation of the economically significant inventory risk to ANELCO. But if we now change the facts and suppose that Brasilco independently forecasts Brazilian demand, determines how much inventory to purchase and hold, it can materially increase or decrease the inventory levels without the Dutch approval. It decides how to respond to changes in local demand and makes the key decisions when products become slow-moving or obsolete. In that situation, I would have a much more difficult time concluding that ANELCO controls the inventory risk simply because the agreement says that it does. So the key point I would like to make is that holding inventory is not the same as controlling that inventory risk. And even performing inventory management activities doesn't necessarily mean that Brasilco controls the economically significant risks. We need to distinguish between the routine operational decisions and the decisions that materially affect the level of uncertainty and exposure. Finally, suppose the agreement provides that ANELCO reimburses Brasilco for obsolete inventory, and we see that this also happens in practice. I would be careful about how I use that fact. I would not say that ANELCO reimburses Brasilco, and therefore ANELCO bears the inventory risk. That would be a circular reasoning. Instead, once my analysis of the economically significant decision-making supports the conclusion that ANELCO controls and assumes the inventory risk, the reimbursement mechanism may be consistent with and give practical effect to that risk allocation. So first analyze the control over a risk and then ask whether the contractual and financial consequences are consistent with the transactions we have delineated. So in practice, don't only ask who holds the inventory, ask why that level of inventory is held and who makes the economically significant decisions that create and manage the resulting risk. And this analysis follows the risk framework from Chapter 1, Section D1.2.1 of the OECD guidelines, which requires us to identify the economically significant risks with specificity and then analyze, among other things, which party exercises control over those risks and has the financial capacity to assume them. I'm happy to see some more cameras on. Yes.
If I could
Sure,
do a
Bruna.
question, make a question, and probably you and Agata could answer as well. I think one challenge that always comes when we are doing transfer pricing analysis and the delineation itself, and clients normally want to understand, and the practitioners, is how do we define who is making the decision if this person has actually the power to decide? The thing about like controlling the risk. I know that we always say that who has financial capacity, who has the knowledge, experience, and know-how, and etc. But how in practice do we frame that? I think that's really subjective, of course, because you know sometimes it's just like, okay, I can put somebody in the Netherlands, and this person can make all the decisions, and then I could put a huge capital in that company. But in the end, it's a centralized business. And I know that the Brazilian headquarter or whatever headquarter is making the final decisions. How do we in practice? Of course, I have my perception about it when I'm doing the analysis, but I want to hear you as, of course, this is your session. I wanted the students to understand a bit like how you define it when you're doing your analysis. I know it's a subjective questions. I know it's hard, but I think that's one of the most difficult points. Like how we define who makes this decision and who has this power to do this decision. Because one thing is to look at in theory. The other thing is, how do I define it? And sometimes it's not unusual that you talk with and you make interviews with 2, 3, 4 people, and they say they make the decision and they do have financial capacity. But in the end, I mean, you have the CEO who is the last person in the chain making all the decisions. And there is about also understanding whether this company is centralized or decentralized and so many other points that come all together, as well as you and Agata were mentioning, because this for me is the most difficult part, because it's not just about financial capacity. If you look at in the books of the company, if it has the capital or bears actually the burden of the risk, but I mean, how do I define that these people has the knowledge and who actually controls the risk? So it would be really nice to hear from you and how this is being dealt in other jurisdictions, because I think this is one of the topics that's going to be mostly argued by tax authorities.
Yeah, and that's a great question. And in practice, what I do is trying to get to the answer through interviews, asking them to explain how the whole process takes place, and ask multiple people, because there can also be subjectivity in that one person says, I'm the decision maker, but then someone else says something else. So also putting that into perspective, and that the rubber stamping, so just having proposals being put forward to then someone that is the formal decision maker, but that person actually never changes anything and just puts his signature there, that is not the decision making. Agata, you're
I think it's a very difficult question, Bruna. The only thing you can do is try to, well, first, if you understand the sector and how the sector operates, you already have a nudge, right, of how things are working. That's why I think it's very difficult to be transfer pricing specialist that works on everything, from banks to corporates to fashion to pharma companies, right? Because and even within a sector, different companies have different culture and different history and different ways of doing things. So I think you have to look for a few angles to it, right? The contracts is one thing. The financial statements is another thing, right? Sometimes we arrive to a conclusion with the functional analysis, the interviews, but we look at the financial statements and they have a different treatment. And there is a reason why there is a different treatment, right? You look at, again, there is sometimes a lot of public information published around the company, right? From the global annual accounts, from press releases, from information to investors that are telling a different message than maybe what the interviews are telling us. So I think you need to take 4 or 5 points. But I don't think it's easy, because the point of a multinational is to diversify risk, right? And every country is different, and I don't think there is a centralized or decentralized business model. There is a lot of things in between, right? I have Japanese clients that are very centralized on paper, but when you actually look at the business, they're so decentralized because everybody can do what they want, right? So is that centralized or is that decentralized, right? You have this example I gave before of the US multinational that had everything very centralized. In fact, my manufacturing entity was almost like a contract manufacturer, right? That was the policy of the group. Outside, everybody is routine. The rest is in the US. But the moment they are acquired by a Brazilian parent entity, the parent entity, the CEO says, everybody on their own. If they can sell, they sell, and if not, we shut down. So that is, and it's the same company. It's just 6 months later, right? So I think it's a continuous asking you, does this make sense? Do I have enough pieces of information? Can I implement it, right? Because maybe you arrive to an answer that you cannot implement. I'm like, okay, this is ideally, but in fact, I cannot implement it. So what is the other way that I can? And many of these things that Lucia are explaining, it's, and especially the beginning, is simplifications that we have arrived to because we do this so many times, or because the supply chain is so complex that we cannot, for each separate transaction, start thinking of a different TP policy, a twist to the TP policy, many times the first thing they say, I want it simple and I want it everywhere the same. So that's also an instruction, right? I want it simple and I want it everywhere the same. So, but I think that the thing also on the control over risk is that the way it's written in chapter 1, for me, is not very easy to understand. It's very theoretical, right? That's why it's nice that you try to give it a practical twist. It maybe works if you are thinking of a model supply chain in the pharmaceutical industry, right? Like when they are talking about DMP and they are trying to make the connection to the stages of R&D development in pharma. Okay, it works for that pharmaceutical company that you were thinking about, but it doesn't work in mining and it doesn't work in financial services, right? So I don't think I have a good answer. I just try to take pieces, and end up being like a little bit of
and it also confirms, Agata, that there is no one size fits all, that is very dependent on the case, and hence you need to analyze the specific case and not jump too quickly to the conclusions.
Yeah, and I think one other point that it's so good to hear you, and that's also why I wanted to see your perspective on that, and for the students to have it as well. Is much of it is going to be also on how the company proves it, right? How you prove that you're actually you actually have the control in Brazil or in any other country or in the headquarters or not, and how you do it. Because in the end, it is, as we are mentioning here, like you have so many years of practicing transfer pricing. In the end, it's always subjective. It always depends on the case by case level, and somehow there are sometimes it's so complex that you can come to different positions throughout the analysis, right? That happens. Sure. You start with an idea, you change it in the middle of the way, and then you go back and forth so that you can have like a final position. So you are always like questioning yourself throughout the whole way, right? And it's good to know that for companies that when we are talking about delineation, and I don't know, of course you have much more experience in terms of case law, it's how you're going to prove it to the tax authorities, because in the end they didn't make this go forth and back. And how we prove them that actually that's how we make the decision. That's the one who controls it. It's not just about like get into the theory, get the article, okay, who has the financial capacity and makes the decision, right? So I think that's what came from your answers as well. So this is really important.
Yeah, definitely.
Yeah, and this whole chapter 1 revamp with all the wording on accurate delineation of transactions is very convoluted, very difficult for a non-native speaker to say that accurate delineation of transactions. This is from 2015 or 16, right? It's not the chapter 1 before that was very conceptual, very basic, talk about the arm's length principle very much in general, right? And now this chapter 1 is like the pillar of the rest of the OECD guidelines, right? But
and also with risk, of course, since 2016.
Right. But sometimes it only makes sense when you read other chapters. Only when you read the chapter on intangibles, then I say, oh, I know what they meant on chapter 1, right? Or when you read some of the examples on intercompany financing, then, oh, I understand now what they meant on chapter 1, right? So maybe it's a book that you have to read backwards and start with the other chapters, or read the first one, not understand it, and say, okay, I don't understand it, then read the others. And on case law, Bruna, as well, because these changes are from 10 years ago. The case law we are dealing with maybe now is from 9 years ago, right? There are audits from 9 years ago that went through the audit process, then they went through the lower courts, then went. So we don't have a lot of these things yet, I think, right? Other than, I think the courts use a little bit of a common sense approach, right? And they will say, well, don't mix to me cash pooling with guarantees, and please try to separate those. So when you actually read some of the cases in the Netherlands, they're a lot more sophisticated than you think, right? But I echo the point of Lucia. It's not just about understanding the transactions, but how are they connected to each other, right? And to me, that point of control over risk is not clear when you are working in a multinational group, yeah? Because at the end, I could say what you say, that the CEO decides on everything at the end of the day. And then that's the last piece, right? Which doesn't give us the right answer, right? That's just too simplistic as well. So, yeah. But I don't think there is any case law, as far as I know, on control over risk, and there are very extreme cases, right? On lack of substance, abuse of law, really the empty holding on IP company, but not so much in the middle. Sorry, Lucia.
Yeah, we see it more in terms of business restructuring, where indirectly there is this relevance on characterization, but not yet on the application of a type of transfer pricing method based on the risk profile, more on the restructuring itself. So if we summarize the risk control, Bruna, on slide 15. So what do we actually mean when we say that the entity controls a risk? Under the OECD framework, control of risk requires two things. First, the entity must have the capability to make the relevant decisions concerning the risk. So capability here is relevant. And second, it must actually perform those decision-making functions. So the first is the decision whether to take on the risk in the first place, and whether and how to respond to the opportunities associated with that risk. And the second is the decision whether and how to respond to the risk once it has arisen. So if we're looking at information that is being shared, looking at the example on the inventory, who receives that information? Who evaluates that information? Who has the expertise to understand its implications? Who decides what actions should be taken? And is that entity actually making those decisions in practice? And to your point, Bruna, to actually document that, also the decision making, that will be helpful in the case that you need to defend your position. So I would want to distinguish between three things: is providing the information and the advice, performing the day-to-day risk mitigation, because it's perfectly fine that an entity controls the risk, but then has outsourced day-to-day risk mitigation activities. That does not in itself mean that the risk has shifted. And then thirdly, making the economically significant decisions through which the risk is controlled. And then the further requirement is having the financial capacity to actually assume the risk. So if I would bring this to down to a line, is that control is not about whose signature appears on the approval. It's about who has the capability to make the economically significant decisions and actually makes those decisions. And this is all in the 6-step analysis for risk in control transactions in section D of chapter 1 of the OECD guidelines. So now we've looked at the contracts, the functions, the assets, the economically significant risks, and importantly, who actually controls those risks. We can therefore return to the question we started with: what is the transaction that we're actually pricing? Now we bring all the pieces together. So we started with the agreement. It essentially told us Anelco sells goods to Brasilco, which is a limited risk distributor. That was our contractual starting point. But after analysis, we now considerably know more. We know that Brasilco actually does. We know which of those functions are economically significant and which are more routine. And we know which assets it uses. We have identified the economically significant risks associated with the transaction. And rather than simply looking at where the financial consequences of those risks ultimately appear, we have analyzed who has the capability to make the relevant decisions and who actually makes those decisions in practice. So suppose our investigation ultimately shows the following. Anelco determines the global product and brand strategy. Anelco controls product introductions and discontinuations. It determines or approves the significant parameters governing inventory levels and makes the key decisions concerning material excess and obsolete inventory. It therefore controls and assumes the economically significant inventory risks and has the financial capacity to do so. Brasilco, meanwhile, performs the local distribution and sales activities. It manages the customer relationships, negotiates with customers within defined parameters, and carries out day-to-day inventory marketing activities. It may also control certain risks of its own, for instance, defined local credits or operational risk, depending on our facts. As you see, we have a much richer picture now of the transaction than just the words limited risk distributor that we received at the beginning. And this is what I mean with accurate delineation. We are identifying the actual transaction by bringing together the economically relevant characteristics of the commercial and financial relations between Anelco and Brasilco. The contract is part of that evidence. The conduct of the parties is part of that evidence. The functional analysis is part of it, the risk control analysis. And all these pieces need to make sense together. So I would be careful not to turn this into an exercise by asking, is Brasilco an LRD, yes or no? Such label can be useful shorthand, but the label isn't the delineation itself. Two companies can both be described as a limited risk distributor, but nevertheless have materially different functions, assets, and risks. What matters for the transfer pricing analysis is the substance of the entities and the arrangement behind that label. So question to class, at this stage where we are, have we determined the arm's length price yet? And answer is no. Accurate delineation tells us what we are pricing. It does not by itself tell us the arm's length price. So now we have a properly delineated transaction to which we can apply the remaining transfer pricing analysis. So delineation tells us what transaction we need to price, and it does not yet tell us how to price it. So now that we have accurately delineated the transaction, let's compare the two parties. On the one hand, we have Anelco. Anelco owns and develops the relevant IP, determines the product and brand strategy, controls important strategic risks, and makes significant decisions concerning products and broader business. And on the other hand, we have Brasilco, and Brasilco performs local sales and distribution activities, customer relationships, local markets, knowledge. But based on the facts we have established so far, its activities are more routine and it does not appear to make unique and valuable contributions. So which party appears to be less complex? Well, probably Brasilco. But I want to be precise about what it means to be less complex. We're not saying which company is smaller or has fewer employees or which is the local entity. We are comparing the functional profiles in relation to the controlled transaction. So here the bigger picture is relevant, and then looking at the two entities to that transaction. And based on the facts we've analyzed, Brasilco appears to be the less complex contributor. And that is an important conclusion. But I want to stop here before we turn to the conclusion into another shortcut. So does the fact that Brasilco is the less complex party mean that Brasilco is automatically our tested party? And my answer is not yet. And the words not yet are important, because identifying the less complex party does not yet determine the transfer pricing method or whether we need a tested party at all. So we've just concluded that Brasilco is the less complex party. So does that automatically make Brasilco the tested party? Not yet. Brasilco being less complex party is a conclusion from our functional analysis, but we have not yet selected our transfer pricing method. So I'm going to park that conclusion for this moment. My next question is not which party should I test? It is what is the most appropriate method for the transaction that we have delineated. And because we're dealing with the sale of tangible goods, one thing I would investigate is whether there are sufficiently comparable uncontrolled transactions that provide reliable price information. So I would ask the client, does Anelco sell the same or similar products to independent distributors? And in this case, it turns out that it does. Anelco also sells the same product to independent distributors in Chile, Mexico, and Colombia. So potentially, we have internal cups. And in one of those transactions is sufficiently comparable to our transaction with Brasilco, we may be able to compare the prices directly. And if the cup is the most appropriate method, something interesting happens, because then we don't need a tested party. We're then not testing the profitability of a party. We would be comparing the conditions of the controlled transaction with the conditions of the comparable uncontrolled transaction, rather than testing the profitability of Brasilco or Anelco. So the fact that Brasilco is the less complex party does not automatically lead us to the conclusion that we should apply the TNMM. So if we look at the next slide, where we have the internal transactions, and the question is, could those serve as internal cups? We should investigate those transactions. So let's take Chile here as an example. Suppose Anelco sells the product to Brasilco for 120 and to an independent Chilean distributor for 100. Same product, same seller. Can I then conclude that Brasilco should also pay 100? And we cannot say that immediately. The question is whether the transactions are sufficiently comparable. So we're going to compare the internal transaction to the external transaction with the Chilean distributor. We already know Brasilco quite well, so I'll not elaborate on that. If we look at the Chilean distributor, we know that it's an independent entity that determines its local commercial strategy. It makes significant local marketing investments at its own expense. It determines its own customer pricing, decides how much inventory to purchase and hold, and bears significantly greater inventory and market risk. Now, the fact that it buys exactly the same product becomes less conclusive. An independent entrepreneurial distributor, assuming those functions and risks, may negotiate a different purchase price from a relative routine distributor such as Brasilco. And then looking at the transaction terms. Here may also be different terms that are applying in practice. So suppose Brasilco purchases 10 times the volume from the Chilean distributor. It has different payment terms. Suppose freight is included in the Chilean price, but is charged separately to Brazil. Those are all factors that may affect price. Some may be relatively straightforward to adjust for. And the CUP says that if adjustments can reliably be made, you are allowed to make those adjustments in applying the CUP. Freight, for example, may be capable of a reliable adjustment. If we have good evidence of volume discounts, perhaps volume can be adjusted for as well. Other differences may be a bit harder to quantify. And then markets. We have Brazil as market versus Chile as market. I don't reject the CUP simply because they are different countries. I would ask the question, do the differences between those markets materially affect the price? Competitive conditions, market size, regulation, import conditions, purchasing power could all be relevant. If they do materially affect the price, the question comes, can I reliably adjust them? So bring this together. We started with something that looked extremely attractive, this internal CUPs, potentially same seller, same product. But after looking at the transaction properly, we see that Brasilco is relatively routine and the Chilean distributor is much more entrepreneurial. There are different volumes, different payments and delivery terms, and potentially meaningful market differences. So in this case, the CUP would not survive, and we would go back to the selection of the method. So finding an uncontrolled price is the beginning of the CUP analysis and not the end. We actually need to compare the transactions and not just the products. So now, yeah, sure, Luis.
Quickly interrupting you. And what about the options realistically available? How do they affect this calculation or this analysis that you are showing us?
So the options realistically available is generally something we apply when looking at business restructurings. So if a restructuring takes place within a group, what are the options from the perspective of both the entities in entering into the transaction in terms of delineating regular intercompany transactions from the perspective of both entities? It should be arm's length to enter into this transaction. So in the analysis themselves, I generally don't take an options realistically available segment for general delineation of intercompany transactions, but for business restructurings, yes, I do focus on that.
Okay, thank you.
So if we go to the next slide, we concluded that we don't have an internal CUP. What do we do next? Bruno, the next slide, please. And again, I don't want to make the next mistake, which would be no CUP. Fine, let's use the TNMM. We still need to ask, what is the most appropriate method for the transaction we have delineated, taking into account the information actually available to us? So before moving to the TNMM, I would want to consider the other traditional transactional methods. So could we, for instance, use the resale price methods? And conceptually, that certainly is relevant for a distributor. But in practice, we don't use it because of the requirements of having information on gross margins. In practice, differences in functions and in the way costs are classified between cost of goods sold and operating expenses can make gross margin comparison difficult. So based on information availability, we would generally discard the application of the resale price method. What about the cost plus method? So that method is generally more aligned with transactions where costs provide an appropriate basis for measuring the value of the functions performed. For example, manufacturing or service activities. And for a distribution transaction where Brasilco earns its return from performing distribution activities in the markets, a cost-based method is less naturally aligned with the economics of the transaction. So we have considered the alternatives. CAP is not sufficiently reliable. Resale minus cannot be applied due to insufficient information on comparables. And cost plus is less appropriate for the transaction we have delineated. So now TNMM becomes our candidate. TNMM is a one-sided method, and we therefore need to identify the party to which we can apply the method most reliably, and for which we can find the most reliable comparable information. And now our tested party question becomes relevant. So if we look back at our FAR, our functions, assets, and risks analysis told us that Brasilco is the less complex party. That conclusion did not in itself make Brasilco the tested party. We first had to determine which method was most appropriate. And now that we have selected the TNMM, the less complex party analysis becomes directly relevant. So can we now simply say Brasilco is less complex, therefore Brasilco is the tested party? Well, I would say almost, but we still want one more piece of the analysis. And that is to ask whether the TNMM can actually be applied reliably to Brasilco. Can I identify sufficiently comparable independent distributors? Can I obtain reliable financial information from them? Can I calculate an appropriate net profit indicator on a reasonable, consistent basis? And are there any features of Brasilco that would make those independent distributors unreliably comparable? Suppose the answer is yes, we can identify a sufficiently reliable set of comparable independent distributors, and Agata will walk us through how to do that in practice in part 2 of this session. And now we can conclude that Brasilco is likely to be our tested party. So the conclusion on less complex comes from the function, assets, and risks analysis. The tested party follows from reliable application of the selected methods. So no reliable CUP does not automatically mean TNMM. We still have to select the most appropriate method before we conclude that the TNMM should be applied. So why does everyone love the TNMM? Under our facts, we have concluded that a reliable CUP isn't available, and the TNMM may be the most appropriate method. Why do we see TNMM so frequently used in practice? Well, there's a very practical reason for that, and that is data availability. It's often extremely difficult to obtain detailed information about prices and contractual terms in transactions between independent parties. But we can often obtain financial information for independent companies from databases with easy-to-apply search criteria. And the TNMM can also be less sensitive than a price method to certain product differences. So TNMM can be a very useful and reliable method, but this is where a practical advantage can slowly also turn into an analytical shortcut, because people begin to think a distributor equals TNMM, or a routine company equals TNMM, or even TNMM is the OECD's preferred method. And none of those propositions is correct. So the data availability explains why TNMM is frequently used. It does not make TNMM inherently the preferable method. And that brings me to some of the TNMM misconceptions that we encounter in practice. And maybe you guys have encountered other ones, but I've put these 6 on the slide. The first is that routine entity equals TNMM. No, a routine functional profile may make a one-sided method easier to apply, but we still select the most appropriate method based on the transaction and the available evidence. As we just saw, we may have a reliable cup. Second misconception is that TNMM requires very little comparability. No, TNMM may tolerate certain differences better than a cup, particularly some product differences, but comparability still matters. Functions matter, risks matter, markets matter, accounting classifications matter, and the choice of profits level indicator matters. Third, if I have a benchmark, I've proved the transfer pricing is arm's length. No, a benchmark is only useful if we're benchmarking the right transaction, using the appropriate tested party, the appropriate PLI, and sufficiently comparable companies. Fourth, the local subsidiary is always the tested party. Tested party selection is based on reliability and comparable data, consistently with the functional analysis, not simply where the entity is located. Then product differences don't matter under the TNMM. They matter less directly than CUP, but they can still affect the functional profile, the market position, working capital, profitability, and comparability. And then lastly, TNMM is preferable because it's easier. Ease of application is not the standard, reliability is. So data availability explains the frequent use of TNMM. It does not make TNMM inherently preferable. And that distinction matters. A method being easier to apply because data are readily available does not make it the most appropriate method. Method selection still has to follow from the accurately delineated transaction and the reliability with which the available methods can be applied. Before we wrap up part one, I would like to walk through this comparison slide, which gives a holistic view on method selection. Bruno, if we can go to the next slide, thank you. So imagine you have three groups all selling exactly the same type of tangible products between related companies. In the first case, the manufacturer sells the same product under sufficiently comparable conditions to independent distributors. In that case, we may have a reliable cup. In the second case, there is no sufficiently reliable price comparison, but the distributor performs relatively routine functions, and we can identify reliable comparable distributors. TNMM may be the most appropriate method. And in the third case, both parties make unique and valuable contributions, and the business is highly integrated. In that case, a profit split may be more appropriate. So notice something important here. The physical product hasn't changed. What changed were the economically relevant characteristics of the control transaction and the information available to us. That is why method selection cannot be reduced to goods transaction equals CUP or a distributor equals TNMM. The method follows the transaction. So the same type of product can require a different transfer pricing method because the transactions surrounding that product are economically different. So if I bring everything we've discussed together, this is roughly the decision path on the next slide I would follow in practice. I've drawn it as a sequence because I think that helps discipline the analysis. But in reality, transfer pricing is iterative. It is dynamic. You may have to go back to a prior step later on in your review. Step one, start with the bigger picture. So understand the business and the value chain. How does the group actually make money? Where is value created? Who develops the products? Who owns or controls important intangibles? What actually drives commercial success? That is why at the beginning of our case, I did not start by asking whether 3% was arm's length. I first wanted to understand what Anelco and Brasilco actually do within the wider business of the group. Step 2, identify the controlled transaction. Then identify the controlled transaction that I actually need to analyze. In our case, that was the sale of branded products by Anelco to Brasilco. That sounds obvious, but identifying the transaction is not the same thing as accurately delineating it. At this stage, I'm establishing what transaction are we looking at, between who, in relation to what products or activities. Then as step 3, we perform the functional analysis. But remember what we discussed. A FAR is not an inventory exercise. We don't simply count the functions. We want to understand which functions are economically significant, what assets are used, which risks matter, and particularly for economically significant risks, who actually controls them. That is why we spend time on inventory risk. Brasilco physically holding the inventory did not by itself tell us who assumed the economically significant inventory risk. We had to understand who made the decisions that created and managed that exposure. Then step 4, the accurate delineation. Using the contracts, the actual conduct, functional analysis, and risk control analysis can now accurately delineate the transaction. This is where we move beyond the labels. The contract may call Brasilco a limited risk distributor. Fine, that's useful information. But limited risk distributor is not the transaction. It's a label. I need to establish what Brasilco actually does, what Anelco actually does, which risks each party assumes and controls, and what the economic relation between them really looks like. Only then do I know what transaction I actually need to price. And then at step 5, only then do I select the transfer pricing methods. And this is one of the central messages I would like you to remember from today. Do not start with the method, start with the transaction. For a tangible good transaction, we investigated whether sufficient comparable uncontrolled transactions could provide reliable price information. We looked at the transactions with the independent Chilean entity that gave us a potential internal CUP. But after performing the comparability analysis, we concluded that the differences could not be dealt with sufficiently reliably. We then briefly considered the other methods and concluded that TNMM was the most appropriate method. So no reliable CUP does not automatically mean TNMM. We also looked at whether resale price or cost plus could be applied. Then in step 6, if needed, select the tested party. Notice where this appears on the decision path. Only after method selection do we know whether we need a tested party. Then the next step, step 7, comparability analysis, and that is something that Agata will walk us through. Only when we have concluded on what is the transaction that actually needs to be tested and for which we need to carry out the comparability analysis, can we carry that out? Which finally results in the outcome of an arm's length result as step 8. And only after we have done that can we conclude whether the 3% that Brazil earns is arm's length. So this process is iterative, but it should not be method driven. I shouldn't start with the database, find some companies, and then construct a functional analysis that makes those companies look comparable. I'm not going to say anything more about the benchmarking because I'll leave that to Agata. But the 5 things I want you to remember from today's session is start with the transaction. Don't start by asking whether the margin should be 3, 4, or 5%, and don't start by opening a database. First, understand the business and the value chain. Identify the control transaction, perform the functional and risk analysis, and accurately delineate what the parties are actually doing. And only then can you sensibly ask how that transaction should be priced. Second, labels are not conclusions. so a contract called Brasilco, a limited risk distributor, that was useful information, but it wasn't the answer per se. We still needed to understand Brasilco's actual functions, assets, risks, compare the contract with the actual conduct of the parties, and identify who controls the economically significant risk. The same applies to labels such as contract manufacturer, commissionaire, service provider, or principal. They are useful shorthand, but they do not substitute the analysis. Third, control matters, particularly when we analyze risk. Don't stop with the question, who contractually bears the risk? And don't simply ask who ultimately suffers the financial consequences. Ask who has the capability to make the economically significant decisions relating to that risk and who actually makes those decisions. Our inventory example showed why this matters. Fourth, method before tested party. This is one of the sequencing points I particularly want you to remember. Our FAR analysis told us Brasilco was the less complex party, but that did not yet make Brasilco the tested party. We first had to select the most appropriate method. So less complex comes from the FAR, tested party comes later if the selected method requires one. And then finally, TNMM is a method. It's not the default setting. There are good practical reasons why TNMM is used so frequently, but it should not be your default. It is often used because of data availability, but you need to have the full picture to be able to conclude whether the TNMM is the most appropriate method. So I would now like to hand it over to Agata to walk us through how to carry out a benchmark in practice. And just wondering if we would like to take a 2-minute break before we do that.
I'm fine. And I think there is a few questions in the chat, and maybe we can address those before we move to benchmarks. And I was thinking of the question of Felipe on the horas. And of course, because I'm curious, I had to go back to the OECD guidelines, chapter 1, and there is one page that mentions horas in the delineation of transactions. So maybe to go back, right, to what I said before, is that chapter 1 has been changed every time any chapter has been added later on, right? And Lucia is right, the concepts of options realistically available show up first, Felipe, in 2010, when they included chapter 9 on business restructurings, right? And they were discussing, well, if you're a full-fledged distributor and you are going to be converted or restructured to limited risk distributor or agent or something else, what are the options realistically available, and would you enter into that transaction from the point of view of the distributor, right?
Yeah.
But it is also mentioned in chapter 1, again, because every time they change the chapter, they change chapter 1 slightly again, right? The way I'm reading that, Felipe, it's a little bit of the characterization of the transaction that Lucia was explaining. You can do in many ways, right? But for example, if you're a distributor in Brazil and you are the only entity or the only party that can distribute that product because, I don't know, because it's a natural resource and you need access to water and only this party has access to water, right? Or you have very specific asset that the multinational needs and only you have access to that asset, right? Then why would I agree to be a limited risk distributor or an agent? Do I want to be more, right? With the potential to earn more, right? So I think that's what those 2-3 sentences in chapter 1 refer to, that even if you arrive to a conclusion, you still have to take distance from it and think, well, does this make sense given the whole context, right? And I think that concept comes later in the point of location, specific advantages, and I put it in terms of a natural resource, but it could be access to consumers, right? If you are the party that have access to that captive market, why would you agree to certain terms and conditions if you can explore others, right? In the context of a group, that concept of options realistically available is always sometimes a bit absurd to think about it, because then you arrive to the conclusion, yeah, we do it because the group says so, right? But yeah, that's the arm's length test. And I think that's the same question Katie Hammond had a little bit on the chat. I had to translate it with Google Translate. She's saying, well, what if the distributor decides to do something else than the parent says, right? And incurs more risk and actually perform more functions than the group has dictated. She starts from the premise that, yeah, the shareholder, the parent entity, has most of the risk because they decide on the key ways of operating the business, right? But what if the distributor decides to do something different, right? And that's a little bit about orders too. Well, yeah, you can do something different if you can, but sometimes you cannot, right? Either.
Yeah. It has to make sense that you're doing something different.
Right. But I think together with that question of Bruna on control over risk, the one of options realistically available to me is the most, I don't think it's subjective, it's mind-blowing sometimes, yeah, how to answer that question when you don't have any options than to follow the governance and the instructions of the group, right? And maybe Cabana had another question about risk of recharacterization. I see the main risk is the tax authorities recharacterizing the transactions. We don't have experience yet. How often does it happen in practice that the tax authorities recharacterize the delineation of a transaction? I always pause a little bit on that question because to me it's what is in a name, yeah? What does it mean recharacterizing a transaction, okay? Because what we see a lot in audits is, for example, the restructuring case that Lucia was referring to. One of the cases that went through the courts in the Netherlands is about a cocoa trader that had a full-fledged manufacturing entity in the Netherlands. They had distribution, they had the trademarks, they have everything in the Netherlands. It has been operating for many years. And they sold certain assets to Switzerland, okay? They set up a principal company in Switzerland, right? And the transaction, the way the taxpayer arranged it, is the sale of certain assets to Switzerland. They sold a customer list, they sold the brands, and they sold some patents, right?
And the contracts were not transferred as such. So the Swiss entity entered into new contracts with the affiliated entities.
Right, but that's what I mean. What is in a name? The Dutch tax authorities didn't recharacterize the transaction, but they say, I don't think you sold an asset, you sold a business.
Yeah.
So to
It's
me,
more
that
about the qualification of the transaction, I would say.
Yeah, but the result is almost like recharacterizing the transaction because you are changing the economics of my transaction so much. It's like if you use for a distributor a cost plus, right? And the tax authorities don't change the cost plus, but they change the markup so much that they change the profit allocation completely. So, yeah, recharacterization seems like a very high threshold to meet in theory in chapter 1, but in practice you can meet it in another way. Yeah, you just change the numbers or you just change the label of the transaction. You did not transfer an asset to Switzerland, you transfer a business. Thus, it's not 40 million, it's 400 million. I have not recharacterized the transaction. I still respect the contracts that you sold something of value, blah, blah, blah. Yeah. But the asset is different.
That is still delineation.
Yeah, that happens a lot actually, David. Yeah. So I think that's quite common. We have also in the Netherlands cases in which a US company buys a Dutch group, a stand-alone entrepreneur, right? And after the acquisition, the Dutch group starts providing contract R&D services to the US, right?
Yeah.
It was a couple of guys in the Netherlands. They didn't have any sales. They didn't have anything valuable to sell yet. It was just a prototype or something to sell in the future, maybe if they were lucky, okay? And the DTA is saying, the moment you enter into the contract R&D agreement, you were a standalone group, 3 guys working on their computer and trying to develop some software, right? No sales yet, no customers, profit potential. But because you enter into a contract R&D agreement, you must have sold the business. So that, to me, is recharacterization. They don't call it recharacterization, but they're telling me, oh, you must have sold the IP because you agreed to enter into a contract R&D agreement, but you had a business by yourself, right? So yeah, even though I read chapter 1 to have that threshold very high on recharacterization, I think in practice, the tax authorities can do things equivalent to recharacterization pretty often, because at the end, it's about the profit allocation, right? So even if you don't change the contracts, you respect the contracts, but you don't respect the result of the contracts. Well, that's recharacterization to me. So that's...
Yeah. Agata, shall we take a 2-minute break before you go on, or?
Yeah, you can do it. I'm fine.
For me, it's fine. Huh? If you're fine, I would say let's go on.
Yeah, we can go.
We can do it 2 minutes then.
You want a break? Okay, sure.
No, I mean, we don't usually have breaks, but I don't know if you need to. It's okay. It's okay.
No, I'm fine.
Or we can. Okay, so let's move on then.
Let's just go. And then I had another comment on the resale price method, right? I actually like the resale price method. I try to use it when I have a chance. I think it was the victim of these changes to the OECD guidelines in 2008 or 9, right? I think another reason why we're using the TNMM a lot is because when Europe arrived or started working more in transfer pricing in 2003, 4, 5, right? The US had already been working in transfer pricing for many years, and they had the CPM, that was the preferred method, right? And actually, it was as advisors in 2003, 4 lobbying to the OECD to change the hierarchy of methods. You know, we had before this hierarchy of methods. First, you try to apply the cap. If you don't apply the cap, then you use the resale price method or the cost plus. And the other 3 methods, TNMM, profit split, and others are methods of last resort. And it was us telling the OECD, well, you know, it's not practical. It's better to try to, in practice, the companies use the TNMM in 90% of the cases. So it almost then became like the default method because we push for it, right? But I agree, it shouldn't be. I think if you do the analysis correctly, you can use the cap and the resale price method more times than we do. I think especially in times like now for economic turbulence in the market, or anytime we see a dip in the market, we regret we have been using the TNMM, right? Because we have all these companies that are making losses, and then we still have to fund the distributors with their fixed margins, whereas we know it doesn't make sense. Maybe it never made sense. It was just done for simplicity, right? Maybe the industry cannot afford it anymore. Maybe we have margins everywhere, and when you look at the leftover, there is no leftover. How can that be, right? So it does bring really, really strange results sometimes, right? It's just that it's easy, yeah, and that most companies use it, so that's how you come to it very often, right?
Agata, if I could just make a question, taking the opportunity, you already answered some.
Sure.
How have you been seeing that in the case law that you do have in the Netherlands and other countries in the EU regarding when you discard the other methods? I mean, disregard the other methods. And normally here, what we are seeing in the transfer pricing analysis, it's a point I've been questioning a lot whenever I have the chance to talk about it. I always tell in the panels I've been debating about it, that we are looking into the transfer pricing studies we have been performing, or that have been performed during this last 3 years. And what we have been seeing is that the discarding or disregarding the other methods, it's pretty much simple. Like, I don't want to use the gross calculation. It's too complicated or something. I mean, it's almost like it's too complicated. I won't apply it. It's not that this is written per se, like exactly like that, but it's mostly like, okay, it's difficult to understand all the costs and the basis for the direct methods, so I won't apply it. And I come to the TNMM, and I would say 90% of the case we go to the TNMM. And my question for you would be, how have the case law been built throughout these last years, or all the years that you already have as experience in the Netherlands or other EU countries, regarding this method selection? I mean, have you actually seen a lot of cases questioning why you went straight forward, or why you didn't give much justification for disregarding one method or the other? Or it's much more conservative approach, and okay, tax authorities are fine as long as you justify that the TNMM is actually applicable and you do have a correct database. And also making a timeline with what you said right now, that it's a change that happened also in the OECD guidelines. We already enter in the OECD guidelines 5.0 I mentioned.
Yeah,
we already got into the last, right?
Bruna, because I do teach a lecture in Vienna on case law, right? And I have a table there in which I summarize the case law that we have around the world. And actually, a lot of the case law around the world is on, is it the cap or is it something else? So there is quite a bit of case law on that. Not in the Netherlands, okay? No. The Netherlands cases are about business restructuring mainly, the recent cases. And before the two recent cases on business restructuring, we had some cases on cash pooling and captive insurance and a little bit extreme situations, right? Or IP empty companies, right? But there is case law method selection in Italy. There is quite a bit, because Italy was one of the countries that didn't want to change the hierarchy of methods, right? There is case law in Australia, there is case law in Canada. I'm sure there is case law in some of the countries of Latin America, if I remember Peru as well. So it's very different per country. So I cannot generalize. I think some countries have still a clear preference in the, maybe because of historic case law, right? Maybe because of how the economy is driven mostly by distribution activities, right? For the hierarchy of methods. And they don't understand the TNMM because they say, yeah, if I'm a country of mostly distributors, right? I don't have natural resources. I don't have technology companies. Why would I agree to have all my supply chain at 3%, right? They want something else, yeah? They want more, or they want at least the volatility. So I think that's why you see the case law in Canada, because there is a lot of sales from the US into Canada. I think that's why you see it in Australia. But I don't think you can have a general rule. It's a little bit country specific, but yes, there is some countries in which there is quite a bit of case law on method selection and trying to prioritize the cap method or the resale price method to others. And some of the case law in Italy, most recent case law of the last 2 years, it's more about that exactly. Okay, but when can we use the TNMM? Is then the TNMM broadly accepted? So it's shifting too, right? But I think you can see very, very different answer to that question per country. Yeah.
Yeah, and I think good to mention why we don't have a lot of case law in the Netherlands is because we have a lot of APAs and open discussions with the Dutch tax authorities. So these discussions are generally dealt with directly with the tax authorities, either confirmation in advance, or if there is an audit, that you come to a solution together instead of actually going to court. And in those discussions, APAs Generally, the method is not what is being questioned. They do look properly at the benchmarks being conducted, and they may have their views on that and require updates on that. So they really closely look at comparability, but not so much discussions on the method in my experience in the Netherlands.
Right. Thank you. Thank you very much, Lucia and Agata. It makes a lot of sense. I mean, I think that one conclusion is that, not conclusion, but one point we should think about is that we do have a lot of distributors in Brazil. we are subsidiary. We have a lot of subsidiaries from foreign multinationals. So it might be that we follow Canada in this perspective. The other point is, even though, I mean, for us, APA is going to be selective in a way that tax authorities will only choose the most complex cases. That's something we have been discussing a lot, whether it should be applied for the majority of the cases, not just for some cases, because then it would reduce the litigation. However, we don't have enough tax authorities to do that, or the knowledge, know-how so far. But it's something we also, like we had Professor Shuedi and Aitor in the first session, and they were discussing this. Also, we do have different perspectives. I don't know, Anas and Luis Felipe as well, and the students, but it's also nice to hear from you. I mean, from the experience, right? So the methodology is something you have already aligned in the APA process. So that's why it isn't challenged anymore. So it's really nice to hear from that. Okay. And I also like, I really liked what you pointed out before we get to Agata's benchmark part, because it's really important as well, is that the labels are not the conclusions. Sometimes we are looking into the studies that have been performed throughout these years, and sometimes it's just like, okay, I'm a limited risk, or I'm a full-fledged, or I'm a licensed, but that doesn't mean everything, because it's just a label, and it's based on some premises, but it can be changed. So it's not that every full-fledged is the same thing. It's just it's a starting guidance, right? It's kind of like you start with a draft of what economically that should look like, but it's not an answer. That's really nice to have it. It's not even something that has been addressed in the OECD guidelines. It's something like, these are the economic models. It's pretty much said, like, dealt with in the business restructuring chapter, but it's not like the model that you should follow. And I think somehow when we are like seeing that in practice, somehow it's, okay, am I full-fledged, or I'm limited risk, or am I a license? And then you get like stuck in the model, and it's not about that at all, right?
Yeah,
really nice.
Exactly.
Perfect.
And there is another question. I think it's interesting. It's David again. He says, when Brazil is performing significant functions, decision making, etc., so they are not the most complex party, right? The tested party is abroad. So let's say it's a trader in the Netherlands or Switzerland or something, right? But Brazil doesn't have enough information to test or to check the results of the foreign entity, and Brazil continues to make losses. What is a possible solution to this, right? I don't know if the question is about access to information in the sense that the trader or the less complex entity is in a non-cooperative jurisdiction, or in a place where you don't have access to what their results are, or just because the benchmark that David has in mind needs to be done in a jurisdiction for which he doesn't have the data. I don't know what what he means on that question, right? But the databases are global, right? And again, I have a lot of slides there on the database, but I don't want to rely too much on the databases, because we know that a lot of the information that comes from there is not good, right? So sometimes you can answer that question by having today with AI and all the access to information. We can look at peers, right? You can look in the annual accounts of competitors, and then you can look for information on what are the distributors of those a group's earning. And I realized, of course, that the group could have their own transfer pricing policies, and maybe it's not arm's length, but does it really happen, right? When everybody has to do their compliance and do that. But I think you need to find other ways to arrive to that information and how to test if the results of the party abroad are reasonable or not, right? And I don't think you test the Brazilian entrepreneur the way you're describing it here, because it is the entrepreneur, right? And they could have losses. But of course, if they have losses for several years, then you would wonder, why would they continue to make losses? And the distributor in Switzerland is making profits and is making very healthy profits, right? So you always have the doubt there that transaction is arm's length, right?
Yeah, and the question whether there is a cap that they could use.
Of course, yeah. Yeah, but I don't understand very well if David is talking about access to information from the
I think a starting principle is
Yeah.
if Brazil is the entrepreneur and not the tested party, and the tested party is a foreign entity, that the Brazilian entity will need to have in its transfer pricing documentation the benchmark of that foreign entity to substantiate the transfer price. So it will really be getting that information from the foreign entity and include that to substantiate it.
Right. Okay. So if the question is about documentation, yes, that's how the report of a principal looks like, right?
Yeah.
That you present in the report of your Brazilian principal the margins of all your distributors, intercompany, or third parties, and therefore explain the results of the principal, right?
Yeah.
Yes, that would be a way to document that. If they do have losses for several years, then you actually still have to answer that question, right? Why do they have losses and the distributors continue to make profits? Do you need to adjust the margin of the distributors? Is something else going on in the sector that explains that, right?
What are the auras for the principal?
Right. Okay. Do you mind to any other questions from the team? Marcelo changed his background in the meantime a few times. He has been on the beach, he has been in a library, he has been in a palace, and he is now in an office. That's nice. Okay, so this is some of the materials we use remember I'm working at KPMG, right? So when we need to explain, when you have done all those steps that Lucia explained and actually need to do a benchmark on a database, what are the steps that we take, right? And I think we have 25 minutes or so to go through this. So I will maybe not go page by page, right? But if you can move to the next slide, Bruna. Because I think the very first step, it's important to remember that there is not only one database, right? And there is not only the databases. When I started teaching transfer pricing many years ago, that's the first question the students, which database do I use? How do I use the database? But Lucia just explained that this is the last question, right? And sometimes it's not even necessary because you have a cap, right? Or because you have other ways to demonstrate or to arrive to an arm's length price. I couldn't share full searches that we do for clients, right? Because there is a lot of value behind that. But there is a publication, Tax Notes International, in which a consultant, a freelance consultant that works in, I thought it was in the US because of his name, Andrew Hooks, but he works in Brussels. I checked this weekend when I was putting the sources. Every year, this gentleman does some searches for US companies. So he uses the US databases and he publishes them in the magazine, right? So if you have a subscription to Tax Notes International, every year he updates a number of 6-7 searches and he publishes the results there in the article, right? It's about distribution of healthcare, of IT, of software. It's about manufacturing. It's about R&D services. And he does it. He puts the numbers there. And I guess it's a little bit of a rebel way to say, well, this is not rocket science. Look, here you have them and use them if you want, right? He only uses the US databases, and I will explain later why sometimes those US databases don't make sense outside the US. They certainly don't make sense in Europe, right? Because, for example, when they do the searches in the US, they don't exclude related entities. So when you see his final set of companies, you see in the pharma sector, the pharma set that he prepares, you see all the big players, Pfizer, McKesson, and this one and that one. And we know in Europe, we are looking for independent companies. So we know, like, well, what does it mean, right? But another interesting thing of looking at his searches over a number of years and next to each other is that even though we do searches in Europe completely different, the numbers are not too different. So you start thinking like, oh, okay, so we spend all this time doing searches and then you do it in a way or you do it in another way. The numbers, more or less the median and the interquartile range is not too different, right? They all affected by COVID. They all affected by the industry cycle. If you look at distributor margins, they all hover around the 2-3%. If you want something much, much higher, you have to go to a specific industry. If you look at manufacturing margins, they all move around the same numbers as well. So please, before you spend all this money on licensing the databases, on spending 40 hours doing a search, because we still do a lot of it manually, of checking whether the companies that are there are your competitors or not, because that's a comment I still get a lot from clients, like, I pay you 7,000 euro to do this, and these companies I don't recognize. I'm like, yeah, we knew that ahead of time, right? So think of what you are trying to achieve, because maybe there are other ways to come up with that number, right? And of course, if you're doing documentation and the legislation in your country or the practice of the tax authorities says this is how you have to do it, well, this is how you have to do it, right? So you will have to do it, and you will have to do it regularly. And we know the OECD guidelines also said how often you need to update searches and how often to do a new search, right? But please remember that there are other sources, right? There are publications that sometimes mention benchmarks of peers, right? There is industry associations, sometimes very strong in some countries. So sometimes when we have been working for pharmaceutical or for very specific players that we know there is only 3-4 players in the market, we have really gone to the industry association, which sometimes, if you're a member, has a lot of data on the peers, right? The returns of the distributors, the manufacturers, the R&Ds. It depends on the country again, and it depends on how reliable that industry association is, right? And the data that they use, whether it has been audited or not. And but you find other ways than just the commercial databases, right? And again, what I'm doing here is just the commercial database and the steps there and how to arrive to something more or less comparable, right? And then the examples I put there are some of the commercial databases that, the prior one is still Bruna, that we use in Europe, right? Amadeus, Orbis, some of the portals that some of those service providers use, right? We have at KPMG in the meantime our own portal as well. And then for the search for royalties, there is many things too, right? We put there a few, but it is KT-Mine, Royalty Stats, Royalty Source, Royalty Sprint. There is like 6 or 7 database that you can actually pay. You can actually get a license, or you can pay per search, or you can use 2 or 3 of them at the same time because you don't find enough results, right? I have checked with the team recently if with AI now we can do a royalty search by just doing a free search myself and just look for royalty searches on the whole thing. It doesn't work yet, but I think eventually we will get there, because these databases, for example, the ones for royalties, is just a standalone entrepreneur or a couple of people in a place that have been gathering data from the newspapers, from the SEC filings, from license agreements that get published, and then they gather this information for the last 20 years, and they sell it, right? And they sell it to you with a portal that is more or less easy to use. But if you do use the database very often, you realize, oh, come on, how come that I always get agreements from the 70s and the 80s and I don't get recent agreements? Yeah, because maybe that's the only thing that they were able to find, right? And these agreements maybe were published then, and we don't have anything else more recent, right? So there is, especially for those royalty databases, they are not very reliable, right? That's why in many countries you cannot do a royalty search alone. You need to do it together with another profit split method or TNMM. And then the databases that we use for financial services, financial transactions, which are very well-known players, right? Thomson Reuters, Bloomberg, and then some of the sub-products that they have, DealScan, RiskCalc. Very expensive licenses, right? So sometimes we don't have all offices, for example, that have the license to certain products. So we pull within the license agreement. But I have also found clients that they, in the meantime, found out that one of their subsidiaries, maybe the M&A team somewhere, has access to one of the databases. And then actually, instead of asking us, they actually ask their M&A team to use the database for the purposes that they need, right? So please just remember that I'm just explaining the steps on the Amadeus database in this case, right? But there are other databases, the one for royalties, the one for financial transactions, and maybe other sources that you can use as well, okay? Yeah, you can move to the next slide, Bruna, thank you. Okay, and then what we're trying to do in the database is, from that very big pool of companies that there is in the database, we try to apply certain screening criteria that are basically mirroring the functional analysis that Lucia just explained, to try to arrive using these criteria to something that looks like the tested party that Lucia defined in her example, right? So I have some criteria to define the geography that I'm using, and I try to look for independent companies. This is not the case in all the countries, right? My US colleagues don't reject related companies. They look for consolidated data, but they don't reject independent companies. Of course, we look for companies that are active, and we look for companies that have enough number of years of data available, and I put there a question about whether we include companies that make losses or not. I think this is a little bit specific to the country that you are working with. In the Netherlands, for example, we have always included companies that have 1 or 2 years of losses, right? But not if they have 3 years of losses, because that would be strange, right? But the last few years, the last 3-4 years, we see the Dutch tax authorities pushing a bit on why include companies that have losses, even if it's only 1 year of loss, and shouldn't you reject them, right? So everybody's looking to, when you are a TNMM country, everybody's looking to bring the number up. And if you include companies that make losses, that you're bringing the number down, the range down. So by excluding loss-making companies, you will just bring all the numbers up, right? So that's a little bit the numbers game of including or excluding loss-making entities, but I'll come back to that later as well. You can move to the next slide, Bruna. Okay, so the database is organized with certain basic features. I think it's easier to see later on the database itself, but it has NACE codes, right? That starts with all the raw materials and natural resources. Then it moves to all the manufacturing codes, and it does all the manufacturing codes by sector, right? Natural resources, industrial products, technology products. So they're like, it's a long list of the NACE codes, the same NACE codes that you use for customs, or the same NACE codes that I have to use when I'm onboarding a client, for example, right? So that's just international, I think. Then there are some options to do some word search, which we try not to use too much, because when we use it, it brings sometimes strange results. So we try to limit that word search to the extent possible, and only if we have too many companies to search from, then we use that. But the word search is basically relying on the business description, and because this information in the databases come from the Chamber of Commerce, so they translate the information from the Chamber of Commerce, right, and then they put it in this global database. Some countries have very detailed business descriptions, and some countries have very short business descriptions, right? And some companies use the filing in the Chamber of Commerce as a marketing pitch. So they put that they do a lot of things, even though, in fact, they don't do so much, but because they know maybe that's the database that a potential buyer of the products is going to use, right? Sometimes they just say a lot of things that they don't do yet, maybe they are planning to do, right? So it's not so easy to rely on the business description of the Chamber of Commerce. So try to avoid that word search if possible. Then we look for the ownership structure, and we delete, in the Netherlands, we delete, well, it depends a little bit on the advisor that you're working with, but at least our team deletes all the companies that have any subsidiaries, right? So we really try to pick fully independent companies, right? But sometimes if we have a search that doesn't yield enough results, and we have a group that is a Dutch group and has only Dutch subsidiaries, or if we can see that it's only 2 or 3 subsidiaries and we can get the consolidated data, we may need to include that, those type of companies, right? So we can play a little bit with that independence criteria, but we have a standard way to do it, and only if we don't arrive enough, then we can see if we need to change that, okay? And of course, we look at the
question to the Brazilian team. My understanding is that the threshold for Brazilian benchmarking and affiliation is a bit lower, so it's not 25%, which I see usually it's 20 exactly. And that, how do you deal with that in practice? Because the databases may not have this search criterion on 20. Have you encountered that yet?
Sometimes you need to look into public data. So you go into like information about, if you have, like, for instance, North American companies, you do have a lot of public entities. So you go there and you can check whether there has a shareholder above 20%. Also in the database, depending on the database, for instance, TP Catalyst, you can check out whether like there are any shareholder that owns more than 20%. The problem comes when you go into individuals. So I think that's not being obeyed per se, like 100%. Because if you would check out every individual that would have more than 20% in a company, it might be difficult. It's like, I don't know if that's also a point, because it's 20% overall. So any type of relationship. But if you exclude all the individual as well, so sometimes you might end up with less than 4 entities. What happens according to the legislation is if you have less than 4 comparables, then you can increase the comparability, the relationship for 25%.
Right.
But that is something we are waiting for the tax authorities to change the normative instruction. That's been like, we have made several requests to the tax authorities, considering that we end up sometimes only with Chinese entities or other type of entities that mostly because we don't have all the data. So it's NA, and then people consider it as it is okay, but NA is not passing the test.
Sure.
So it's a complication. Right. So I think it's going to be changed. For instance, in the US is 50% or something like that, right? I don't know in the Netherlands specifically if Agata or you, Lucia, mentioned, but that's something we need to change. And also putting that out is just like we cannot consider companies that have losses for more than 1 year. So in the average of 3 years, the company should always be profitable, Agata, in Brazil. It's because of that as well.
Yeah,
they have foreseen
that. That's what we generally do in the Netherlands.
Yeah, that makes sense.
We have a lot of TNMMs. So we would only have losses if we would agree on like having loss.
Right. So it's a way to protect the tax base, right?
Mm-hmm. Mm-hmm.
And Bruna, you said, so basically because Amadeus doesn't have the 20% threshold, as far as I remember, but I will see the screenshot now. You have to use the 25%, which is the lowest they have, right? And then
if you get to less than 4, you need to do all the comparable search first. Then if you after you have searched and look into the kind of the relationship that these entities do have, if you end up with less than 4 entities as comparables, then you can increase this criteria to 25%.
Right.
But Amadeus right now is already like combined with the TP Catalyst, so you can check it. You can already include that filter at the beginning when you start your analysis, but sometimes you need to get through it, Agata. You do have a point, because sometimes even if you put the filter, there are a lot of NAs, so you need to check it elsewhere as well. So that's a good reminder.
Right. Okay, all right. Okay, and then of course we exclude everything that could be cooperatives, NGOs, non-profit organizations, or anything like that, right? And sometimes we include if we have too many companies, and this is mostly European searches, okay? Turnover threshold, right? Still within the database. And actually, we use it a lot because sometimes we get way too many companies to be able to screen manually, and that will make the search very expensive, right? So we try to adjust that number to something that makes the final set that we download and we have to screen manually manageable, right? So less than 300 companies. I don't want to have to screen 500 companies or more than 300 companies, right? But very often as well, when we have a client that is very sophisticated and has seen many searches or have done many searches and doesn't like the set and wants another set, sometimes we have to play with that turnover, or doesn't like the number that we come up with, right? We need to play with that turnover threshold to say like, okay, well, let's look at a broader pool to see if we find something better, right? Or if we have something different. So that's something that we sometimes need to go back to when we have done a search, like you are doing with the ownership, right? If you arrive to something that is a too small set or doesn't give you a good answer, is not logical, then you need to go back and change a criteria. So that's the criteria we are using quite a bit.
Agata, can you consider tax havens or low tax countries as comparables, like entities in low tax countries as comparables? Because we cannot, because in our legislation, if you do have a company in a tax haven or a low tax jurisdiction, it's considered as if it was a related party, so subject to transfer pricing rules. So how does it work in the Netherlands?
No, because we work mostly with the region, right? So once you choose the European region, I think you are excluding most of the tax havens, right? Unless you tell me Cyprus and Luxembourg and Ireland are on that bucket, which they're not. So I think what is happening in European searches is that if you would do a lot of those jurisdictions don't disclose data, so we don't even have the data in the database to start with, right? And you see a lot of bias in the searches, that you get a lot of companies from Southern Europe, right? Because we have more strict requirement on what you can have and need to file in the Chamber of Commerce, whereas you get very few German companies because they can file very simplify financials, right? We'll get very few Dutch companies because the small Dutch companies can file a very simple balance sheet in the Chamber of Commerce and they don't have to disclose the full financials. It means when do a search, the chances that we get mostly, let's say, Eastern European and Southern European companies is much higher than getting maybe Dutch and German companies, just because the data is not there for many of those companies, right? They may file, but they don't need to publish the P&L. And if I don't have a P&L, I cannot do anything if I don't have the profit and loss account, right? So a lot of these searches, at the end, the outcome is also biased by availability of information too, right? But yeah, in theory, you could include tax havens, and if there is data, it would come up, and then you will analyze it, but it doesn't come up. I'll say something about the regions later, because what is happening with the regions, of course, Bruna, is that if you pick Western Europe, or if you pick the full of Europe, including all the Eastern European countries, right? Or if you include also Turkey and Russia and North Africa, right? You can get very different results, right? So that we have questions from the tax authorities sometimes that they say, well, why are you including Turkish companies, right? And then maybe the answer is, well, because my group has distributors everywhere in Europe, including Turkey, and I don't do a benchmark per country, I do a European one, so I include Turkey, right? But with these countries that have a lot of foreign exchange controls or interest rate volatility, right? What happens is that when you do the working capital adjustments, okay, you arrive to a final set, and then you do some working capital adjustments, right? And the working capital adjustments use interest rates. It's not the same to be working with European interest rates, which, even though they are different per country, they more or less hover around the same numbers, that if I'm including countries that are not in the Eurozone, right, and have completely different interest rates. And then that impacts my working capital adjustments a lot, because if they have a inflation and they have a 12, 15%, 20% interest rate, or even 9, 10%, then the adjustment I'm doing to the comps it has a big impact, right? So you have to be careful with that too, not just with the comparability in terms of market comparability, but what are you doing with the interest rates if you're using the interest rates, yeah. All right, so I have 8 minutes. So, but this is just to show, okay, this is how the portal looks, or how it looked when we took these screenshots, right? So you basically have all this data here, and it's a pull-down menu, and then you go and look at the status of the company. So you look for companies that are active. We don't want inactive companies, or companies that are closing down, right? And if you go to the next slide, then you look at the so this is how the menu looks, and then you look active, only pick active, and then you look at the region. This is what you just mentioned, right? And then if you go next slide, Bruna, then you can check here whether you take in the next one. Sorry, let me go to the prior one. Okay, prior one, one more back, one more back. Right, so this is the point that Bruna was saying about, and the next one, Bruna, where how to pick the countries, right? You can take Western Europe, and then you have certain countries there, and then you can decide also, in this case, Bruna, to take Liechtenstein, Luxembourg, Malta, Monaco, or exclude those, right? I think if you will include them, you will not find any data, right? So you can. It depends on your country. If you don't have any guidance on how to select the region, you do your best attempt, right? And but if I have a client that has activities in all those countries, of course I will pick. If a distributor and has distribution activities in Liechtenstein and Malta and Monaco, I'll pick those too. Why not, right? And then, of course, when I do my analysis, most likely there is no companies from that country. But if there is, I need to check. Is this result reasonable, right? Or is it biasing my results because I have 5 companies from Monaco and only 2 companies from Europe, right? That's what we will do. Okay, so the next one is the NASE cost that I explained before, right? And it just, if you go to the next one, you will see that it just shows all the costs that you will be able to choose. Before manufacturing, there is all the raw materials, and after manufacturing, there is all the distribution NASE costs, and then all the services, and then others, right? So you just pick the one that is relevant for you. And this is not too difficult, right? Because you don't want to have too many companies, so you pick the one that is relevant for your taxpayer, for your client. And sometimes if you don't know exactly where they fall, you can also look at the annual accounts of your client, your taxpayer, and see where they register themselves, right? Sometimes they use 2-3 codes, so then you use those 2-3 codes, for example, right? If you pick too many, then you have too many companies. And if you pick too few, then you may end up with nothing. So we do play a little bit. And because we have done so many searches over the last 25 years, sometimes we know, oh, if we are looking for consumer electronics and we don't pick this one, and this one, we're not going to get anything, right? Or sometimes we know, well, we know some of the companies in this sector, they also use the other NASE code, even though that's not their main NASE code, right? So a little bit by doing so many, you also learn which ones you need to pick. Next one. This is the word search that I try not to use. But again, if you have too many companies, you can say, I'm looking for manufacture and I do not want distribution. The risk of using that is that many companies do manufacturing and distribution. And if they use the word distribution in the business description, then you are eliminated. Maybe it was a good one, right? So it's not very good tab to use. And then this is the independence indicator that Bruna was mentioning, and maybe it's outdated. If you go to the next slide, Bruna, because you told me it looks different now. This is what we use in the Netherlands. I don't know that this has changed, that there is more options, right? So we pick A+, A-. We pick unknown as well. And that's it, I think. And then year of incorporation. So we don't want companies that are startup companies because most likely they make losses, right? So we look for something that is connected to, well, which data I'm looking to, right? Am I working in an audit and I'm looking for years data from 10 years ago, or am I looking prospective because it's a planning study, right? So I don't think we have a very set criteria for this, but it's also 15 years ago to search it myself, so it has changed a little bit. Then, of course, we want information. We want that they have a profit and loss account, because if they just have a business description, I cannot do anything with it, right? So I want to download the financial data. It needs to be available. And then I pick the years for which I have the financial data. And again, keep in mind that we're using 3 by default, but it doesn't have to be, right? In some cases, I'm using 5 years because that's what the industry does, or in some cases, I'm using 10 years because I think that's what makes sense for the taxpayer, or maybe I'm doing an audit defense and I want to look at 15 years because I want to look at the profitability of the peers over a number of years, right? So this really depends on what you're using the search for. I think you can go back probably. For sure, I can get 10 years in one row, right, in the download, but I'm pretty sure we can go and do 10 years 2 times and get more data, right? Then this is very useful sometimes if you are doing an audit defense and you need to look at older years, or if you want to show how the peers, comparable companies' profitability has been evolving over a number of years, right? For example, if I see the margins in the industry declining over 15 years, I want to make a case that why do I need to use a number that was set like 5 years ago if I know the trend is like this, right? So this is very, very useful. And we do play with this quite a bit depending on whether the report is for planning purposes or for documentation or for audit defense. And then next one. These are just all the criteria together. And then you see there that they have downloaded 134 companies. Please realize that we are starting with 3 million companies almost, right? So when you pick the active companies, you have 3 million companies. That's way too much. And the only thing we're doing with all these steps is try to create, let's say, a mini functional analysis for the big pool of companies so that you get to something that it's a little bit more similar to your tested party, right? That's what you're doing with those steps. The region, the sector, the business description, that means the functions, the turnover size, right? To pick the size of the company, etc. And I think in the next one, I'm just explaining go next. Next, some of the checks that we try to do, right? So sorry, the prior one, I do have a meeting at 4, guys, so I need to go. But in the next slides, you have basically the checks that we do, right? Before we do the qualitative analysis. And once you have done the qualitative analysis, which basically means downloading this information, reading the business description, and eliminating the companies that do other things or that they, according to the website or other information, they are not roughly comparable to our company, right? We just eliminate them as well. And then we get to a smaller pool of companies, which by no means I'm trying to say they are comparable to ours, but as good as it gets, basically, with this database, right? This is also important. Please, when you're doing a benchmark, don't forget to put the formula that you're using for your operating margin, BERI ratio, net cost plus, return on assets, return on capital employed. Please put the formula, because there is a lot of misunderstanding in audits and in documentation on this, because everybody uses the slightly different formula, right? So either use the one that is in the OECD guidelines, or if you use another one, explain why you're using a different one, right? If you're using the IRS formulas, explain why you're using the IRS formulas, right? And this is how you get to a final set, get the interquartile range and the median, which not surprisingly is around the 2 to 3% that Lucia was putting at the beginning of the presentation. And then in the last pages as a bonus, I have copy-pasted the searches of this. In the next one, Bruna, I have copy-pasted the benchmarks of this Mr. Andrew Hughes, because he has quite a few that he publishes, so maybe they are useful to you. They are using the US databases, so they're only US comparables. So there is one for healthcare, one for IT, one for software, one for construction equipment. And maybe if you look at the results, you can arrive to some conclusions yourself as well. Yeah, sorry to go so fast, but I do have a meeting at 4 p.m. So I'm running late, Bruna. And yeah, so.
Sure. No, thank you very much, Agata. I know that, I mean, when we started the sessions and when we were building the course, it was like 2 hours and a half, or should we get like 2 hours? And then it's just see that the time flies. I don't know how, but it does. Thank you very much. I think it was like a really great session. We had all of the analysis that Lucia and you combined performed regarding the delineation and the benchmark analysis. For those of you that want to know more about benchmark, we are going to have benchmark sets and analysis throughout the other sessions as well. So even though it's not precisely a manufacturer, it will be for services, etc., etc. And then you start to learn a bit more about what Agata is mentioning. But the overall procedure is what Agata already mentioned. So it's really nice that this session could also somehow explain to you that sometimes we think that the benchmark is the most difficult part, right, Agata and Lucia, that this is the most tricky part, so complex, I don't know how to use the data, etc., etc. But the biggest it's a lot of time that we do need to allocate is for the delineation, as Agata and Lucia are mentioning. Because after you did a very good job at the delineation and the recognition of the transaction, you already have the method, you already have the PLI. So you go into the database already knowing what you're searching for. You don't go there blind. You go there and then you already have this database set there. And then you start to like just do the screening, as Agata is mentioning, and putting your standards and what is required under your legislation. And then you come up to the final set and interquartile range. So I think this is really important that you understand this throughout the course. Of course, the database is amazing. We want to understand more about economics, etc. It's kind of like we want to understand it all. But it's really important to know that we come there already knowing what we're looking for, right, Agata and Lucia. And I wanted to thank you very much, both of you. The session was really, really good for me. I'm doing it every day, and I always learn a little bit more. And it was really, really nice to see like all the procedure. That's what we wanted to show to the students. If you do have questions for Lucia and Agata, you can send them to us. We can make the questions to them and then publish it in the course database, which you do have access. The PPT is going to be shared with you as well. So don't be preoccupied. You're going to have the slides that Lucia and Agata were showing here, so you can look into it. And well, so that we can lead Agata to her meeting.
That's fine. Thank you.
Thank you.
Thank you. Bye-bye, Bruna. Thank you, Lucia. Bye-bye, Marcelo.
Bye-bye.